What's happening? Engineer Steve, by the way. You know, if it's one lesson I learned, Steve, is that you are the best engineer in the business. I appreciate you, brother. 2015, year in review. Oh, you blow me a kiss. Oh, wow. That's hot, kind of. Gang, Secret Stash, back live, San Diego, tracking down some cool local people, talking about some cool local stuff, and giving you the best right now of local real estate, mortgage, finance, and even maybe some local economy stuff, and distilling it all down to a 2015 year in review, working out. See how I worked that in? Working out, and I flex my muscle. Working out. The 7 biggest lessons learned, and most importantly, how to apply them to a successful 2016 campaign. We talked about seasons, talked about time in the market, talked about how values are really strong right now and the potential cost of waiting. But what about the actual economy itself, right? So if you look at that, the fact we shared in the last segment, we're up 149 G's with a G apostrophe S in potential median value over the course of the last 24 months. Is that got bubble, man, written all over it?
I hear it all the time.
Or is that just a recovery? Mm-hmm. Now, one of the things that pundits will hang their hat on when you're looking, trying to bifurcate which side's opinion is more equitable in that is the strength of the economy. And chief on that list is jobs.
Especially when you're bifurcating.
Especially when you're bifurcating, Jer. Yeah. The dollar is strong right now. Mm-hmm. As a matter of fact, not only is the dollar strong, but locally our San Diego economy is actually peaking. So, if you look at California as a state, we're now the 6th strongest state for jobs. We're up 2.9% over the last 12 months.
That's good news.
San Diego unemployment rate is down to 4%, which ain't too shabby.
Yeah.
Okay. And jobs, they're actually the highest they've ever been. So they actually passed their peak of the previous high, which was the peak in the middle of the boom, right? So right there at about 2006, 2007, right there when things were just literally, off the rocker. Mm-hmm. A lot of overinflation going on there in many respects. Jobs, of course, chief on that list. We blew past that actually in the beginning of the year, and we're continuing our way up.
That's very, very interesting stat.
Now, a lot of job numbers, especially from you might say, the other side, meaning the political party that doesn't hold the White House, will always try to foo-foo that and say, they're not real, jobs, there's underemployment, there's a lot of service jobs. Not in San Diego. Mm-hmm. These are actually a lot of high-paying jobs, like the medical field, for example.
Interesting.
So what story does that tell you?
Well, sustainability is a really important factor. I mean, I remember an old lesson about watching stocks and dips and valleys and coming up. And anytime you end up passing an old peak, remember the cup and handle or whatever all that stuff was?
Yep.
Right? So anytime you pass an old peak and then be able to continue that momentum, it shows signs of stability and potentially a new norm or a new floor that you can not be so worried about just another dropout.
Jeremy, I think you've passed your peak.
That's for sure. Yeah.
By the way, we're actually streaming this entire conversation live right now on the Meerkat app.
So people can also visually see that I'm past my peak.
Yeah, so if you want to go over to the Twitter handle at Follow the Stash, you can see Jeremy and all of his, I'll call it the lackluster, even though it's normally luster and all your luster. Yeah. And the San Diego market economy, opposite of Jeremy Beck.
Right.
In that it's peaking right now.
Doing beautifully.
It's peaking right now. So more of that, right? And so I think that, and if you look at the transactional history, you can see that we're not at the point where at the boom either. Where there was a lot of overinflation going on. I don't know, you could throw out some stupid stat and say maybe, arbitrarily 25%, maybe even more of the home purchases were snuff and fluff, man. Stated income, people claiming that they made $10,000 a month on their janitorial job. You know what I mean?
That's how we got your first house.
Thank you, Jer. Little cross back there for me.
Sure.
The lackluster comment. Love you.
Mm-hmm.
But where I think this conversation really starts to grab people's attention is with respect to the rates.
Yeah.
So if the economy's doing good, what's the impact of the rates? Now tell us what happened a week or two ago.
Sure. So obviously there's a reflection on the federal level, the national level of the economy doing better as well, and that was the raise in the federal interest rates. And so the Fed rate has now been increased and is slated to potentially increase slowly over time, which is a reflection of their confidence in the market in general. That obviously has a lot of effects. A lot of people came rushing right before that to say, I got to refi before the Fed raises rates. There's not a direct correlate, and I think everybody's heard this at this point, and now it's come to fruition. They've seen it. The Fed raising rates doesn't necessarily increase mortgage rates on a hand-for-hand thing, but it does have some effects.
There you go. Mm-hmm. Yeah, but the relationship is critical. Just because it has the word rate in it doesn't necessarily mean it's going to be the rate when you're going to go try to buy a house, right?
Right. Unless you get a HELOC, and then it's directly tied to it. But what it is a sign of is the overall health of the market, which is going to trend in a certain direction. And they'll probably over time trend together. So as you see the Fed increase rates, we'll likely see the increase of money becoming a little bit more expensive. Interest rate returns are going to be a little bit better in the short-term yield, and that'll eventually trickle into the long-term yield, which is what we're talking about in mortgage rates.
Now, this is the first increase in 10 years. So what happened over the last 10 years that made it either flat or go down that's changed now to make it go back up?
Well, I mean, we had the bubble. You just referred to that. And so essentially that was the Fed's job is to keep the market in a growing pattern. And we haven't been in a growing pattern sufficient enough to ratchet that down in a long time. And then conversely, after the growing starts, they have to keep a lid on inflation. Mm-hmm. That's what raising rates does. It stops things from becoming too expensive or money becoming too cheap.
But inflation has been great.
That's why they have been hesitant to ratchet that up, and that's why it's only gone up 0.25%, and they don't have any plans to do it again soon. This is almost a tester here, a little toe in the water.
So let's go global. Let's pan back to 30,000 foot right now, because you might be like, well, what's that got to do with San Diego, the lessons locally? Mm-hmm. Well, San Diego is a global economy, especially when it comes to real estate, man. I mean, if you look over the last couple of years, a lot of all cash investors, a lot of them from China, for example, propped up a good percentage of our market.
Yeah.
And so if you look, as a matter of fact, at places like China, they're not doing too hot right now, right, with their economy?
Right.
So what do you expect moving forward? Or do you think all cash offers from China, which is a pretty large percentage of the transactions? I think in 2015 they were accounted for about 20% of the foreign, might say investor purchases. Maybe I think it was even maybe upwards of 25%. If their economy's slowing, does that mean that 25% of that market's going to go away?
It's a great question and a great way to look at rising interest rates. Cash is unaffected by rising interest rates, and that's a really important thing. So if it is a good chunk of the market, a desirable area for international money to be coming in, you can expect that money will still flow. And then, of course, defer to you in terms of what that means in terms of competition, viability, price increases, et cetera.
Well, it's going to be interesting to see, right? I mean, so as this dollar continues to strengthen, and by the way, that's an undertone that's not popularized, is that by the Fed increasing the rates, everybody goes, ooh, stuff's going to cost more.
Sure.
But the truth is that's going to strengthen our dollar.
Right.
And so we've got that going for us, which is going to be nice. And the euro right now is going through all kinds of challenges. So a strengthening dollar on a global stage could potentially hedge back a lot of foreign investors who were looking like, real estate in America was on sale for a while, right? So, but the curiosity with that, though, is that, outside of like maybe them wanting to keep their money more domestically to try to, I don't want to give America too much momentum. I'll keep my money here domestically. The fact that they're probably buying all cash, though, is in a stark juxtaposition from what's going to happen here with the Fed, with the rates, maybe if that's any effect whatsoever on the 30-year mark that people are trading mortgage-backed securities on. So I'd probably say foreign investors, all cash, it's high drama. It's probably not going to have too much of an effect. Maybe slightly for some of those other points we talked about the strengthening dollar. People want to keep their money more domestically. But for domestic buyers getting mortgages, not so much.
Right.
So it's really just high drama, is it not?
Sounds like it, yeah.
Or you could maybe even flip the script and say for commercial guys, maybe it's more of an effect for commercial guys, but not maybe for much for residential.
Sure. And I imagine that foreign investment, when you talk about it in that perspective, you're talking about probably some of the beach cities, some of the more desirable downtown places.
Or next to the schools.
Right. So you're going to see that sort of thing, but that obviously has a ripple effect. That's why the external areas of San Diego cost as much as they do, because the internal areas, the places that are in the highest demand, those are getting expensive, and you see that ripple theory.
And what's funny about that is that we're not at a shortage for buyers. You know, and you go back to that example, like back in 2013 when those cash purchases were small. Well, it wasn't to say that there wasn't also loan offers on those same house. They just got beat out.
Sure.
Because everybody wants to work with a cash buyer so long as they're not taking too much of a discount or a shave in the purchase price, right?
That makes sense.
So maybe that'll just recede a little bit, but it'll be backfilled by more domestic buyers that are, you know, were tired of getting pushed out in the last couple markets and not going to actually find their place.
Yeah. That's an interesting look at how economics locally is affecting the actual guy who's out there trying to buy.
So 2 more things we learned, gang. Number 1 is that the dollar is strong and only getting stronger right now. Don't be afraid of the Fed hike. Then they're probably going to continue to do so. I would expect maybe a couple more adjustments between now and the end of the year, and that's okay. It might have an effect on mortgage-backed securities, but more than likely it's going to be a null effect. So if you're a domestic buyer and you're going to be getting a loan, chances are this is just going to be high drama, right?
Yeah, something to think about, more of an indicator of direction, which leads to the conversation we were just talking about a little bit ago about the cost of money increasing for you to buy that same home.
And I would say if the last lesson that we learned about prices going up, about the potentiality of leaving $149,000 on the table if you were renting versus buying over the last 2 years was a great impetus for you to get into our home buyer class so you can understand where you belong inside of all these metrics, inside this greater conversation. Man, the strength of the local economy and where this is going to do, especially in the face of a potential rate rising environment, is a great opportunity for a seller to take advantage of our monthly home sellers course. So if that's you, gang, you're out there, you're listening right now, you own a home, you might want to trade that in for something you've had your eye on, and you want to see if maybe you were a part of that $149,000 gain that happened in the last 2 years and what that might create for some options. I invite you to attend our monthly home seller class, and you can do so by getting your name on the next slot by going to thegreenhousegroup.com/monthly sellers workshop or MSW. You know we love acronyms, right?
Sure.
Keep it easy. Keep the links easy. MSW. That's thegreenhousegroupinc.com/MSW. Man, coming up, I got to say, Jer, this is if this is a year in review about what mistakes not to make for 2016, the next one definitely takes the cake. You're not going to want to miss the stats we have on rents, how much they've gone up in San Diego County, and how much they're going to continue to climb over the next 12 months. And we'll give that to you right after this break. Real Talk Radio San Diego. We'll be right back.